Welcome to Valley Home Vibes, the podcast that's all about the sizzling hot real estate market right here in the Valley of the Sun. I'm your host, GT Campanile, joined by co-host Kevin Price. We're thrilled to have you join us today as we delve deep into the captivating world of real estate right here in Phoenix, Arizona. Today we're discussing creative financing solutions. Disclaimer, these are general outlines of home lending strategies. Please consult a licensed loan officer for your unique situation. Okay, let's get right into it. So, I want to kind of lead us off here, Kevin, just with some low and no down programs. So this means, loan programs where you're putting like either a very, very small down payment, right? Or even none. And then we'll go into some strategies on, how to even help out with like closing costs and things like that. So without further ado, let's jump right into it. All right. So let's go over some low down programs. And these are ones that might see all over the internet where you see like, low down or no down. First ones are conventional programs called Home Possible and Home Ready. So these are 3% down payment conventional programs. And they just use different words for branding. So Home Possible is Freddie Mac and Home Ready is Fannie Mae. Now, these are really income restricted programs. So you don't have to be a first-time home buyer like some people think. It just depends on how much money you make. Now, this usually depends on the AMI, the area median income of your particular zip code or county. I think they go by county. If you go out to the AMI calculator site I think Fannie Mae has one, Freddie Mac has one. For Maricopa County, for a single family residence, the 80% mark, 80% of the area median income is $79,200. And that is going to be your max qualifying income. So the limit, the upper threshold. So as long as you're not making upwards of $79,200, you can qualify for one of these programs. There's another 3% down program that is not income restricted called Home One. Again, this is just branding by Freddie Mac. The equivalent program over at Fannie Mae doesn't have a name, but it is a 3% down program that doesn't have any income restrictions, but it does require at least one borrower to be a first-time home borrower, right? So a first-time home buyer. And when I say, one borrower, that means that if you are, if it's just you, you've got to be the first-time home buyer. If you've got 3 borrowers on there, at least one of them has to be a first-time. So the most popular program, for I think what most people consider kind of a stepping stone loan or a first-time home buyer loan is the FHA loan. And this is 3.5%. So, this is where a lot of people think this is the loan they have to get as first-time home buyers because it is low down payment. Not a lot of people know that conventional you can get these as well, but this is the most common. You can actually get 100% financing with certain programs. So the nice thing with the FHA is you can pair that with, say grants or DPA programs, which have become more popular today. They are, of course, you have to meet requirements, to get into these programs, but typically you're going to come to the table with a 3.5% down payment. And then if you don't have that cash, you can use gift funds to help cover that down payment. So effectively, you may not be coming to the table with any money except for your closing costs. The DPA programs sometimes are grants, sometimes you got to pay them back, but they might be provided by city, county, or community organizations. So the FHA is a great one. The other government program, which is a zero down program, actually, is the VA loan. So of course you have to be a veteran or currently serving to qualify. And this is a great program if you'll meet that qualification, because you can often come to the table with absolutely nothing out of pocket, because the VA is very generous with its guidelines on helping veterans get into homes.
Absolutely, yeah. I've personally have used several VA loans, and the only money I have to worry about is closing costs. I have no money down. The house I'm in right now, no money down. I just had to cover the closing costs, and that was very, very beneficial to being able to get into a house right away.
You and I both. I wasn't a loan officer at the time. When I used my VA loan, I was fortunate enough to have a very good loan officer working on our deal, and I didn't come to the table with a cent, which was I was pleasantly surprised and happy, of course. So the VA loan is a great program of the zero down programs. Now you can also pair conventional programs, as we discussed before, like say Home Ready or Home Possible, and the 3% down conventional programs with a affordable second. So affordable second is a program that is like a second mortgage. So it cannot be a first mortgage. It's going to be second lien. And typically you can get these from maybe local banks or credit unions. And if you can find those, that will pick up at least the down payment portion, and you would have essentially 100% financing going conventional. So, talk to a loan officer on the specifics of these. Let's move on to covering closing costs. So some folks think that your down payment is your closing costs, but I like to keep them separate. So your down payment is basically your skin in the game. Right? Mm-hmm. That's the skin in the game that you're going to show the lender that you're committed and that you're on the hook as well, right, for buying this home. Closing costs are the transaction costs that you're going to be paying both to many parties. People always think it's just the lender you're paying. It's not true. The lender actually has very few fees in there. The only thing you're really paying for is like maybe a credit report, an origination fee, and some government fees for what's called a MERS report and things like this. This is more of like high level mortgage stuff for processing this loan. So there are only like 2 or 3 lines of fees of all those dozens of line items that you see on the loan estimate. Right. The rest of them are going to be like appraisers and title company. The government has some separate charges and what's called other fees. That's usually on your right side of your loan estimate. And then of course there's going to be the prepaids, which pretty much is like the interest that you have to pay before you make your first mortgage payment, because interest is always paid kind of like ahead of time. So there are, and then of course your insurance companies, we can't forget those guys. They usually want 12 months of premium up front, right? And then you have to fill your escrow account, and then those are also going to be part of those closing costs. So there's a lot of fees on there that your loan officer would go over with you and explain all of them. Yeah. And you can actually have all these fees paid for with the help of either the seller, the lender, or your real estate agent as a credit. So it depends on the market, of course, but if the market is moving in maybe the buyer's favor, which is rare of recent times, but even in a balanced market, you can sometimes find homes that have been on the market for a while, and the seller will be very willing to negotiate on credit. Now, credit comes in many different amounts, and there is no necessarily set amount. It depends on really the loan and the program. Conventional, you can go up to 9% credit, and that's 9% of the purchase price, okay? And that's a massive amount. FHA allows and the conventional portion, you want to talk to a loan officer because it's a gradient. That 9% is just the max. Typically, if you're coming in with like the minimum down payment, it's only 3%. Okay. But FHA is pretty much that flat, 6%. Right. So this equates to quite a bit of money when you're looking at a $400,000 loan. You can virtually wipe out almost all your closing costs and perhaps even buy the rate down with leftover credit. Yeah. Okay. So that's how you would maybe pay for some closing costs. Mm-hmm. And that is something that you would involve your real estate agent partner, if you're a lender, because they need to really kind of figure out the specifics of that for you. And then if you like the numbers that you're presented, it's the excellent way to go to get rid of those closing costs.
For sure, yeah.
So the other topic I want to talk about was, what if you've got income problems? Now, you can you can't really do anything about low income. If you have low income, that's how you're going to be how you're going to qualify for your mortgage. They're going to say, hey, you qualify for this much based on your income. You can potentially qualify for more home if you maybe mess with the interest rate, right? You can buy the interest rate down with maybe those credits that you get, or if you have cash, you can of course come with your own cash and buy the interest rate down, what's called discount points. Now, one discount point is about 1% of the loan amount, and 1 point buys the rate down by only 0.25% on your interest rate. So, this is helpful, particularly at these higher loan amounts. It makes a big difference on payment.
Yeah, absolutely. And I think that's what trips up a lot of people is the 1% and the percentage per point is everybody thinks it's 1 for 1, and unfortunately it's not.
It is, yeah. That it's a good point. People often get confused. They think that one discount point is 1% on the interest rate, and I can tell you it's not actually exactly. One discount point brings the rate down by 0.25%, right, of 1%, 1/4. Sometimes it could be 1/3. It just depends on the rate sheets. So
Okay.
Your lender. Remember, banks are borrowing from usually either wholesalers or getting their money from Fannie and Freddie, who are getting their money from investors. So this is an open market where rates are actively traded, and it doesn't always equate, right? It has to do with risk and risk appetite of the investors. It doesn't always equate for that one discount point equals 0.25% on the interest rate. So that's something to discuss with your loan officer and get an accurate rate quote, so that your LE will reflect what you might be going to the closing table as far as cash out of pocket and your monthly payment. So there's another way that you can actually qualify for the mortgage with income with a lower rate, like to bring down your what's called debt to income ratio. But there is a way that you can actually pay less on your mortgage, and this is what you might have seen in the news of recent, particularly since rates have gone up, and that's what's called a rate buy down. This is different than a permanent rate buy down, which is what we were discussing with discount points. These are temporary points, and they go by the names of like either 3-2-1 buy down or 2-1 buy down or 1-1 buy down. These this rate, so if you're quoted a 7% interest rate, a 3-2-1 buy down would basically mean that you're going to get a 3% interest rate on that first year, a 2% lower on that second year, and in the final year, the third year, you get 1% lower. So basically, you can look at it as 3% lower, 2% lower, 1% lower of your original qualifying rate.
And that's with the idea of being able to refinance before the full time is up. Is that correct?
That is correct. Yeah. So you're going to be underwritten on your qualifying rate. So there's no real advantage there for qualification purposes. However, in real dollar terms, you're actually saving quite a bit of money if that interest rate is 3% lower. So instead of, on like a $500,000 loan, you might be saving $500, $600, $700 and even more, right? And this is a big deal for people that actually want to save real cash, right? Each month on their mortgage. And then you're absolutely right. You're expecting to refinance out of that within that 3-year time frame as the rate increases to that original qualifying rate. And I'm careful to use the word adjust, because this is not an adjustable rate mortgage. Usually they are 30-year fixed mortgages. It's just that it steps up incrementally. Mm-hmm. It is not an adjustable rate mortgage.
Yeah, not an adjustable, but it does go up as the years pass.
Each year, every 12 months, that rate will it not adjust, because I'm careful to use that word. It will go up by 1.
Now, I got a quick question if I can interrupt. So, the new home builders right now, are throwing tons of deals out there. Is this something like a rate buy down? Is that something you would be able to add on to going through the home builders lender, or is that something that it just varies with every case? Can you add multiple options together?
Yeah, you can stack some things, but it may not be something from both the builder and if you're going to say an outside broker. But
Okay.
if the builder has their own kind of finance arm or a lender that they're working with, they will probably be able to offer what I've seen is either or, right? You're either
Okay.
taking the credit or you're getting that or you're getting the option upgrades, right? So
Right.
really it's a credit that's going to go towards your rate, and they build that into their marketing materials because that credit is just going towards getting you a really great rate.
Right.
And
Okay.
I've even heard there's more complicated strategies with this where they had purchased low rates from long ago for lower, and they've kind of like locked it in, so to speak. And this is kind of beyond the scope of this conversation, but builders have a lot of tools
Yeah.
at their disposal. But typically, that would be something you're going to qualify with the builder, and they're going to usually request or demand that you use their internal lender, and then you can
Right.
negotiate from there.
Okay, that makes sense.
So there's another strategy if you want to actually get rid of your mortgage. So we're going to move from, say, the purchase transaction to when you start paying your mortgage. What if you want a lower mortgage payment or perhaps no mortgage at all? And this isn't like buying the rate down. This is actually what you would do is look at the type of property. And there is an allowance to buy multi-unit properties with conforming loans. So you can buy up to four-unit properties. So you can buy a duplex, a triplex, or a fourplex and still get conforming or conventional financing. Now, the strategy here is you're actually allowed to live in one of those units and rent out the others. And some people will buy, say, a fourplex, and then what they'll do is they'll rent out the other three, and they'll charge whatever the market allows, and hopefully that will at least lower or even eliminate your mortgage payment. Now, conventional financing allows this, and you can put typically it used to be, I think it was like 10 or 15% down, right, for the multi-units. But now they had recently changed the rules to allow for 5%, which is
Okay.
the minimum down for, like, say, multi-unit properties. Now, most people think that this is maybe only a conventional, like Fannie and Freddie, thing. Only conventional financing allows this. FHA and VA allow this. So you can go to the FHA, you can put 3.5% down. Don't quote me on that. You want to talk to your loan officer. And you can rent out the other 3 units if you're buying a 4-unit home, live in one, and hopefully that their rents will cover your mortgage. So that's a strategy to eliminate or at least lower, your mortgage payment. What are these multi-unit properties hard to find, Kevin? I mean, are there still a lot of them on the market?
Yeah, there definitely is multi-unit homes out there. I would say that the biggest restriction on those is going to be the location of them. Just in our area, we don't have that many, but when you get closer to the cities, there are more there. So it just depends mostly on the location. I would say is the biggest restriction, but there are plenty of them out there. I have a client that looks at those every single day. So yeah, the multi units are out there. It's hard. Another restriction is going to be the quality of them. Sometimes they're not well maintained, so to say. But that's one of the things that I've seen. Other than that, no, you can still find these 2, 3, 4 4-door properties any day that you want.
I do know that, maybe not here in the Phoenix market as you stated, but I know there's a lot of these in Chicago, and I keep hearing that from people that in Chicago you have a lot of multi-unit properties. Obviously, Chicago's a massive urban area,
Yeah.
and you might find a lot more variation out there being so densely urbanized. But you can eliminate your mortgage, which I think is a very cool strategy. So lastly, I want to talk about these. So all these strategies have been mainly for primary home buyers. So what that means is this is going to be your primary home. But I would like to go to investor. Okay. So investor home buyers or investment home buyers have some tools also that they can use to get into a property with maybe not the kind of the low down payments that the primary home buyer can get, but you can get in with maybe not qualifying your income. So typically, if you're going in conventional financing as an investor, you're going to have to show tax returns and your income, and that's how you're going to be qualified. Now, there's a program that has come over from mainly the commercial real estate world, that's called a DSCR loan. And this stands for debt service coverage ratio. And this metric calculates whether your rental income covers your mortgage. Mm-hmm. So you would really only need to show your credit report, your FICO, which typically is, you're going to qualify with a 720 or better, but I've seen as low as 680, depending on the terms of the deal and your situation. And your closing funds, which typically is the lowest I've seen is 15%, but okay, you'll be more comfortable and you'll get better terms at 20 and 25% with these kinds of loans. So yes, more down, a little better credit situation, but you do not have to show your income. And this is kind of like for mainly business purpose, right? A lot of investors who are buying these strictly for investment portfolio. Mm-hmm. But an easy way to get qualified.
Yeah, and like you said, you just have to show the rent history, so to say, as being able to cover everything on that.
Yep, you'll have your they use the term net operating income, which mm-hmm, you could just say rent. And then, of course, all of your expenses, right? So this includes your mortgage, and some lenders include some other things. But as long as your rent is covering that mortgage or your expenses, then you're probably going to be good to go. Now, there are different lenders that have different levels or different amounts that they qualify you at. So sometimes they want to see that your rent covers more than your mortgage, that you've got a surplus, right? You're profiting. Others actually will take a little more risk, and they will allow you to take a little bit of a loss. Typically, you have to show some reserves for that, meaning you have reserve cash in the bank. But this is a good program if you, let's say, have a lot of properties, or you're just not wanting to show income. Maybe you've left the workforce to pursue full-time investment, and you can't show income anymore. But you have a ton of cash. This would be the program that you'd want to.
It's a pretty unique way to be able to get started with investing and getting real estate properties.
Absolutely. Yeah, I think it's a great program. So that's a wrap, folks. If you have any questions about creative financing solutions, feel free to reach out to us using the contact info below. Lastly, please don't forget to click the like button and subscribe. I'm GT signing off from Valley Home Vibes.
Hey, thanks everybody.